The previous decade is characterized by incredible performance by US tech companies, but the question now is whether that's going to persist in the decade ahead. So in this video, we're going to look at reasons why China might be the potential torch carrier for equity performance in the decade ahead, both the pros and the cons of investing in China, but also how to actually get exposure to the Chinese market, because there are many funds and sectors which you could consider. Now remember, if you do want to learn more about investing, you can do that very easily and very well by signing up for our free weekly market roundup. You'll find a link in the description below me and above me. So now let's look at investing in China in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start out looking at the reasons why you might want to invest in China. The reason why any of us are interested in a particular market is that we might get good returns there compared to the rest of the world. And if you look at the Chinese CSI 300 index, which looks at the largest 300 companies which trade on 2 exchanges in China, the returns since 2005 have been extremely good. So on average, that's returned about 13% versus about 7.7% per year from the S&P 500 in the US, and just 7% from a broad MSCI Emerging Market Index. Now, many of these funds have only come into existence since that dataset started in 2005. But this ETF actually goes back that far. It's the iShares China Large Cap ETF, and that's had a return of only 7.8%. So many of the new funds that we see springing up are trying to give us access to this CSI index and the shares which trade in that index. But notice this very large rise and fall in the CSI index that was around the time of the global financial crisis. So remember that this is an emerging market. It comes with very high volatility alongside that prospect for greater returns. As usual in finance, there's no free lunch. So you've got to be willing to swallow that risk in order to get access to that potential greater upside. If we are going to be investing for a long period of time, which of course, as a watcher of this YouTube channel you are, then something like education is very important. And one thing that really stands out in international comparisons of educational achievement is that China performs very well. So this is the OECD's Programme for International Student Assessment, and these are results from 2018. And China is not just a little bit ahead of other countries, it's miles ahead. So certainly by this measure, educational attainment in China is very strong at the school level. And you've probably come across this graph before as well, which is the number of science, technology, engineering and mathematics graduates broken down by country. And here again, China completely dominates the world, with almost 5 million recent graduates in 2016, which is almost twice as many as the country which comes second, which is India, whereas the US had only generated 568,000 graduates. Why does that matter? Well, of course, growth is generated by innovation. So while this doesn't guarantee innovations in technology, which then feed through to corporate earnings and innovation in the tech space, it would be amazing if it didn't have at least some impact. Another place where China may be very successful in the decades ahead is in the development of 5G. And that infrastructure will allow for a lot of growth to be generated through new innovative uses of technology. So for example, that could create a whole new Internet of Things which can talk to each other very rapidly. And it's possible that there could be innovations that we haven't even thought of that become possible once that fast connectivity is in place. And according to GSMA, 70% of global 5G connections came from China in 2020. And what they extrapolate is that by 2026, 5G will be on a par with 4G. So if China continues to dominate that space, it could certainly give them a technological advantage, but also they could be at the forefront of this technology. Now, it may be for political reasons that the US and China split the world into 2 poles, and that'll be split pretty much based on geography and where exports are currently dominant. So for China, that would be in Asia, although about 1/5 of its exports in 2018 went to the US and another 1/5 went to Europe. Whereas the US will service its own neighbours in Canada, in Mexico, but to a much lesser extent countries in Asia. But there too, about a fifth of US exports go to Europe. Now, in the previous decade, what's really dominated in the US, of course, is the growth of technology, which is now making up a very large proportion of US indices like the S&P 500. But the growth in emerging markets over the last decade has been in the consumer discretionary sector. Perhaps that's because of the increasing wages that we've seen in emerging markets, and that's meant that people in emerging markets have more money to spend on discretionary, non-essential items. And that growth in the consumer discretionary sector has led to huge dominant companies based in China, such as Alibaba Group, for example. It's always nice to have a perspective of how large a market is, and beneath me here you can see the MSCI All Country World Index, which is a global index created by MSCI that includes emerging markets as well as developed markets. And China's a fairly small part of that. It's only about 5.5% as of 2021. It's much smaller than the US, which is about 57% of that global index. But if instead we look at the MSCI Emerging Markets Index, you can see that China makes up about 40% of that index. So it's extremely dominant within emerging markets. So a very simple way of getting exposure to China is to buy one of the trackers for MSCI emerging markets. Of course, it won't be pure China, but it will be dominated by China with a bit of diversification in other countries in the region. And if we take a look at the size of the CSI 300 index, which we saw previously, that's got the 300 largest and most liquid stocks that trade in the China A-share market, which we'll see a definition of in just a moment. But the size of that market, the market capitalization, which is the number of shares times the share price, would be just under 20 trillion yuan, which converts to just over 3 trillion US dollars. And to put that into perspective, Apple's market capitalization is around $2 trillion. So certainly as I make this video in 2021, it's not a huge market, but it's an increasingly important market. When we see market crashes in China, it now starts to affect global volatility. So let's quickly touch on what we mean by A shares, B shares, and so on. A shares are the shares which Chinese people would trade on Chinese exchanges. They're priced in renminbi, the Chinese currency, and they trade on the Shanghai and Shenzhen stock exchanges. B shares are also traded on those two exchanges, but those are priced in foreign currencies. H shares trade on the Hong Kong Stock Exchange, but they are the shares of companies incorporated in mainland China. Red chips are also traded on the Hong Kong Stock Exchange, but these are the shares of companies which are state-owned. So implicitly they're owned by the Chinese government. P chips are privately owned companies. They're often incorporated in places such as the Cayman Islands or Bermuda or the British Virgin Islands, but they have their operations in mainland China. Let's have another look at the returns we've got from Chinese funds, but also, critically, the risk you take with those funds. So this is a risk-return plot. The axis beneath me, the x-axis, tells you what risk you're taking, with low risk here on the left and high risk here on the right. And then on the y-axis, you've got the historic return, with low returns at the bottom of the graph and high returns at the top of the graph. For comparison purposes, I've also added the Life Strategy funds here, from Life Strategy 20% equity all the way to Life Strategy 100% equity, and also the S&P 500. And this gives the annualized return between 2012 and as I make this video in February 2021. Now notice how all of these Chinese funds are shifted to the right of the graph. That's where the risk is higher. And that hasn't always given a higher return. So for example, this cluster of funds here has a higher risk than a 100% equity fund here at the top of the graph, but you haven't been compensated with a higher return for taking that risk. Whereas if you look at these A-share trackers here at the top of the graph, the risk is higher, but so's the return. And that's where most of the innovation in Chinese funds has come from, in funds which track the A-share market. Now, if we look at some of those new funds, and unfortunately that means we can only track data going back to 2020 in October, and here the returns are no longer annualized. And during this period, you can see that the returns were very good for the Chinese equity market. And we also now have single sector exchange traded funds, such as this CraneShares CSI China Internet Fund, which although it's very high risk, has given a very good return over this period of time. Another way of looking at these funds is in terms of their popularity, which is how much money is flowing into the funds or out of the funds. So now instead of risk on the x-axis beneath me, we've got the amount of money flowing into the fund over the last year. And the y-axis is the unannualized return over the last year as well. So here's that Crane Shares CSI China Internet ETF, which has performed very well, and it's also seen inflows over that period of time. So anything to the right of this line had inflows over the last year. Another fund that's been very popular, but which has also had very good returns, is this Crane Shares MSCI China Environment ETF. And as we saw previously, emerging market returns in the consumer discretionary sector have been very strong. And that's probably why there have been very big inflows alongside the very high returns for this ETF. Another theme which is interesting is the China Healthcare Index ETF, because it's no longer the case that China's a very young country, and one sector that always benefits from an aging population is the healthcare sector. And another popular theme is to strip out state-owned enterprises from the China index. And if you think Chinese tech is going to dominate in the decade ahead, something like CQQQ could be interesting, and that's an Invesco China Technology ETF. Now, as time goes by, we'll probably see a better suite of exchange-traded funds, which will give us access to more sectors. But it's already the case that you can buy many of these interesting themes. Now, if you want to look up this stuff yourself, there's a very good website called ETFDB, which allows you to do this. And this is their ETF screener tool. So you just go to the equity section and you'd scroll down and select a region, which is China. And here you can see they list 45 exchange traded funds. Now what I've done here is to sort by inflows over the previous year. So here we've got an inflow of 148 million into this CSI 300 tracker. And the second most popular in terms of flows over that period has been this Wisdom Tree X State-Owned Enterprises ETF. Now, one of the things to note is that the expenses for these funds tend to be quite high. So here's the expense ratio in this column. And if I sort that into reverse order, some of these funds are incredibly expensive. Usually the ones which are leveraged, which you probably want to keep away from anyway. And if I put it into ascending order so you can see the cheapest funds, the Franklin FTSE China ETF comes out as cheapest, but even that is 0.19%. Now as there's more competition creating Chinese ETFs, these expense ratios will probably come down. If you're based in the UK, you can always use the Just ETF website to do something similar. So you go to the ETF screener, you choose equity, and then for country, you'd choose China, and usually I sort in ascending order by expense ratio, so you see the cheapest funds at the top. And again, Franklin comes out top of the list, but here we have some European ETF providers rather than US ones. Now you might think it's strange to remove state-owned enterprises from a Chinese index, and this nice graph from Wisdom Tree explains why that might be a good idea. And the fundamental problem is that if you do have a state-owned enterprise, it's not necessarily run for the interests of its shareholders. And that's borne out by the fact that the returns on the XSOE index are considerably better than the index which includes state-owned enterprises. And the definition of an SOE here is that the firm has more than 20% of their shares owned by government entities. Now in China, just as in the West, people are growing more aware of environmental issues, and there are many companies which address those environmental concerns. You've probably heard of the electric car company NIO, and possibly also BYD. Warren Buffett famously invested some money in BYD. XPeng is another up-and-coming EV company, but there are also some green energy companies in this index too. So I think that's another sector that could be really interesting in China in the decades ahead. And the recent performance of this Crane Shares Environment ETF has also been very good. So in case I'm painting too much of a rosy picture, let's consider what problems there might be with this market. This is an extract from a speech recently made by Joe Biden, and what's pretty clear is that he sees China as America's most serious competitor. And he's really not pulling any punches here. He says he's going to confront China's economic abuses, its aggressive, coercive action. Perhaps he's talking about the South China Sea there. But he also talks about China's attack on human rights, on intellectual property, and on global governance. Now, of course, those are just words, but we saw what happened with Huawei, where not only did the US ban Huawei's products in its own 5G network, it stopped other countries, such as ones in Europe, from doing so either. So the political standoff between the US and China could directly impact share prices in China, and that's always a risk you have to consider. Now, we often talk about concentration risk in the United States, but what you can also see here in this fantastic interactive graph from MSCI is that the top 5 stocks in the MSCI EM index also make up over a quarter of that index. And it's no surprise that that's dominated by Chinese companies, such as Alibaba and Tencent. Concentration may give you higher returns, but it could also pose a risk. And you just can't ignore the politics in China. And one example of that was a disappearance of Jack Ma just at the time when his company, Ant Group, was about to have an IPO. Now, the IPO itself was halted, but much more disturbing was the fact that the CEO just disappeared. And in fact, the shares rallied by about 8% when he reappeared. Now, that's just another example of risks which you have in emerging markets, which you don't usually have in developed markets. As annoying as he is, we wouldn't expect to see Elon Musk carted away by the men in black. So I certainly think there's an interesting case to be made that investing in China makes sense, over and above its weighting in a global index. So for example, you could have a global equity tracker in your core part of your portfolio, but then go overweight China or maybe just emerging markets in order to get that balance between technological innovation in the East and in the West. Now, this is the kind of topic which we discuss all the time in our Patreon community. We discuss it on Slack, but also members vote for videos which I make for members only. And for example, one of the videos I made was about concentration in global equity markets. So if you do want to both support us and make sure we can carry on making these videos, which you probably find helpful if you're still watching, then why not join our Patreon community? There should be a link in the description below me, and there will be a link you can click on beside me in order to find out more. And as always, thank you for listening.